जस्ट चेक सेशन आ रहा है क्या देख. Hello friends and welcome to Crack CA Exams with us. Welcome to Unacademy, India's largest online learning platform. This is Prathik Gupta here and I welcome you to my session today. The session today is going to be on income from house properties. Alright, so Unacademy provides to you a wide range of courses, resources and contents which covers various examinations, various topics of your interest, and you're free to choose the topic or the content that you feel is of interest to you and the educator that is of interest to you. Crack CA Exams with us is a CA vertical started to help CA students pursuing the CA Foundation, Intermediate and Final course help in their examination, get help in their examination preparation. So let's start off and let's crack CA exams. A little introduction about the educator, that's me. Hello, I'm Prathik Gupta. I am a Bachelor of Commerce from Christ College, Bangalore University. I am an associate member of the Institute of Chartered Accountants of India. I am an associate member of the Institute of Company Secretaries of India and also an associate member of the Institute of Cost Accountants of India. Along with this, I'm also a law graduate from Karnataka State Law University and a visiting faculty in a number of institutes for CA subjects and an educator for CA students both offline and online. Prior to starting my own practice, I worked with SR Bartley Boy and Associates, that is the Indian member firm of Ernst & Young Global, in the Audit and Assurance Department, and Ernst & Young India in the Mergers and Acquisitions Department. I also worked with the Manipal Group as the corporate controller of the German entity located in Frankfurt, Germany. So thank you and welcome to my session. Unacademy has a Plus subscription platform that it offers to students and subscribers. What do you get if you subscribe to that subscription? You get daily live classes where you can get to chat with your educator, engage in discussions, ask your doubts and answer polls, all while the class is going on. Not only this, you can clear your doubts then and there as and when they occur, and you do not have to wait for another day or an appointment or to fix up a schedule to clear your doubts and have discussions. You can do it then and there. The platform helps you by conducting live tests and quizzes which help you evaluate your preparation with the regular mock test and quizzes and get detailed analysis of your performance. Now, what does this do? This helps you in identifying your weak points and your strong points, overall evaluation of where you stand and which subjects or which parts you need to pay more attention to, identify your weak areas and your strong areas, to work on your weak areas and eventually make it into a strong area of yours. The courses provided by the Unacademy Plus platform are structured courses. They are structured in such a way that all the courses are in line with the exam syllabus to help you best prepare for it, and best efforts are made to ensure that no important topic or subtopic is missed out, and you get to have a complete preparation for your examinations. And lastly, and most importantly, unlimited access. One subscription gets you access to all the live and recorded courses to watch from the comfort of any of your device. So not only this, you get to choose the topic, the subject, the educator, and one subscription gets you the access to all the live and recorded courses to watch from the comfort of your house. You can decide the timing, you can decide the educator, you can decide the topic. What more, you can do it whenever you want in your free time. And also this whole course comes onto your mobile as well, so you can carry it wherever you want and access it whenever you want. So I hope all of you make use of this opportunity and come onto the Plus platform of Unacademy as soon as possible. For those of you who have downloaded the Unacademy Learning app and are using it, I would like to thank you very much and expect your continued support. For the people who have not downloaded the Unacademy Learning app yet, I request you to download the Unacademy Learning app from the App Store and register on it. The registration process is quite easy. You need to enter your mobile number, put an OTP, and you get the registration done. And then you carry the entire world of courses, resources, and contents of Unacademy in your pocket so that you can access it at any time at your convenience and whenever you find the time for it. You really don't need to probably schedule a time or sit on your laptop or sit on a desktop or go for classes. You can download the app and use it whenever you want. So once again, for the people who are already using the Unacademy learning app, thank you for your support, and please continue to support with us. The people who have not downloaded the Unacademy app yet, I request you to do it as soon as possible and make use of it. The Unacademy Plus program provides subscription on a fee model, that is a monthly subscription or a quarterly or a half yearly. I am part of the CA Foundation and Intermediate course. So the CA Foundation and Intermediate subscription plan are as follows. The Unacademy Plus program for CA Foundation and Intermediate provides plans for 1 month, 3 months, 6 months, 12 months and 24 months. The 1 month plan costs you rupees 3,150. The 3 month plan costs you about 7,875. The 6 month plan costs you about 12,600, and the 12 months plan costs you about 15,700, and the 24 months plan costs you about 18,900. So you can make a choice of the plan that you require and make a subscription. And while making the subscription, please do not forget to use the code Prathik, Prathik, to get a discount of 10% on the subscription price. I repeat, Prathik. I personally would recommend to you the 12-month and the 24-month package for two reasons. One is it is cost effective, and secondly, for any professional course or any difficult course, you require a period of 12 months to 24 months to prepare. So this would give you ample time and opportunity to cover up all the important areas and the difficult ones. So my personal suggestion is 12 months and 24 months, but you're free to do the subscription of your choice. And do not you forget to use the code Prathik, Prathik, to get a discount of 10% on the subscription price. All right, so today's topic that we're going to discuss about is income from house property. Now, earlier I have also conducted a session on income tax. I have I've done a session on residential status and scope of income. So in that I did mention about we need to determine the residential status, that is resident and ordinary resident, resident but not ordinary resident and non-resident, and accordingly what the scope of income will be. Okay, so now let's come to income from house property. Now, what is house property? As per the Income Tax Act 1961, there are 5 sources or 5 headings of income that you need to post your income or classify your income into. The first one being income from salaries, that is mainly what the salaried employees earn from working in companies on employment basis. Then next one is income from house property. This heading basically involves your income that you earn in the form of rental from letting out or subletting out of your house property, and then letting out of your house property. Then the third head of income you have is income from business or profession, where a person is carrying on a business, trading, manufacturing, or providing services, or there is any profession like a chartered accountant carrying on his profession, a lawyer, a doctor, a cost accountant, a company secretary. All these are professionals. So whatever money they earn through carrying on their professions will come under income from profession. All right, so today what we're going to do, profession, the fourth head of income is capital gains, which simply means whenever you buy or sell any capital asset is which is supposed to be meant to be used for a long period of time and not meant to be traded. Okay, so whatever gains or losses come from that comes under your fourth head of income, that is income from capital gains. And the fifth head of income is income from other sources, which constitutes or contains incomes which do not form any of the first 4 categories. That is your income from salary, income from house property, income from business or profession, or income from capital gains. This does not, so whatever does not come there will come under income from other sources. The examples for income from other sources are your interest on SB account, interest on FDs, then if you've received any other kind of income like home tuitions or whatever, all that comes under income from other sources. So today we are going to discuss the second head of income, that is income from house property. And I hope you find it useful, and in case you have any questions during the same, please let me know and I will be happy to answer it. Alright, so chargeability. Chargeability is section 22 of the Income Tax Act 1961. Now, the process of computation of income under the head income from house property starts with determination of annual value of the property. The concept of annual value and the method of determination is laid down in section 23. The annual value of any property comprising of buildings or land appertaining thereof, of which the assessee is the owner, is chargeable to tax under the head income from house property. All right, so now please remember, please read these 2 points. The first point says that the income or computation of income from house property is contained in section 23, and if you see, it starts off with the determination of annual value. So there are 2 values we need to determine, which we will see again further. One is determination of annual, one is determination of gross value, and one is gross annual value, and one is determination of net annual value. Now, what is gross annual value and what is net annual value? We will discuss that as we proceed. Okay. All right. So now, please remember the condition. The first and foremost condition is the assessee should be the owner of the property. He should own that house property. That means it is a building or land appurtenant thereof. The value of any property. So he should be owning that property, that is a building or the house, and he should be earning rental income from that. If these conditions are fulfilled, then this income will fall under income from house property. Otherwise not. If he is not the owner, then this income cannot be charged under income from house property. All right. I hope we are clear so far. Yes. Any questions? You can please ask. All right. Now the conditions for chargeability. Now please note these are the basic conditions for chargeability of income under the heads income from house property. Property should consist of any building or land appurtenant thereto. Buildings include not only residential buildings but also factory buildings, offices, shops, godowns, and other commercial premises. Land appurtenant means land connected with the building, like garden, garage, etc. That means forming part of the land, not an empty land, not a separate piece of land. It should form part of the land containing the building. So buildings not only include residential building but also factory buildings, offices, shops, godowns, and other commercial premises. But please note that if a building is being used for business purposes, like your factory buildings, offices, godowns, shops, then that income will not be chargeable under income from house property. That will be charged under income from business or profession or income from other sources, as the case may be. So only if a property is being used for residential purposes and is being let out for residential purposes, in that case the income from that property will be charged under the head income from house property. Then the second condition, the assessee must be the owner of the property. As owner is the person who is entitled to receive income from the property in his own right. The requirement of registration of the sale deed is not warranted. Ownership includes both freehold and leasehold rights. Ownership includes deemed ownership. The person who owns the building need not also be the owner of the land upon which it stands. So let's go one by one. Owner is the person who is entitled to receive income in his own right. Like I said earlier, one of the main conditions is that the person who is receiving the income should be entitled to receive the property in his own right. He should be the owner. The risks and rewards of the property should belong to him. He should not be a person who has been authorized by another person to do it or something. In that case, the income will be of the person who's authorized him. But he should be receiving the property in his own right. All right, as the owner of the property. The requirement of registration of sale deed is not warranted. Now, what happened now? A lot of times a property is bought or sold, but the registration process takes a little time due to various reasons. Like for example, due to COVID right now, the registration of a sale deed or something was delayed. So that does not mean that he is not the owner of the property, as registration is just a procedure or formality. But if he is the rightful owner of the property, the registration of the sale deed is not a prerequisite for him to become the owner of the property. He is the owner of the property the minute he buys it, and he can establish his claim on the property. Third one, ownership includes both freehold and leasehold land. A freehold land means free of all charges. That means it has not been mortgaged, it has not been given as a security anywhere. And leasehold rights means a property which he has obtained on lease. A person who owns a property on lease. Lease is a way in which a person can become the owner of a property for a particular, or holder of a property for a particular period of time on a payment of a lease amount, and after the expiry of the lease term, then the amount has to be returned to him. So even in this case, he needs to do that. All right. So ownership also includes deemed ownership. Now there are a lot of cases in which he could be a deemed owner. A deemed owner is a case where he's not the actual owner, but due to law or due to the process of the law, he becomes a deemed owner of the property. We will discuss that further as we move on. The person who owns the building need not also be the owner of the land on which it stands. So if there is a building on a particular land, it is not necessary that that person needs to also own the land. The land can be taken on rent, or the land can be taken on lease, and he can build a property on it and be the owner. In such a case, then the person will still be deemed to be the owner of the property, and any income received from such a house property will be charged under income from house property. I request you to take 30 seconds and just go through this slide, and then we proceed. All right, just take about a minute more and just read it. Okay. All right. Now, the third condition is use of the property. The property may be used for any purpose, but it should not be used by the owner for the purpose of any business or profession carried on by him. Excuse me. Okay, so it should be, so the purpose of the property, the property may be used for any purpose, but it should not be used by the owner for the purpose of any business or profession carried on by him, the profit which is chargeable to tax. So that property, house property, can be used by him for any purpose, a storeroom or for his own residence or whatever, but it should not be used by the owner for the purpose of any business or profession carried on by him. In that case, you cannot get the income from house property. Okay, property held as stock in trade. Now, what do we mean by property held as stock in trade? Let's say a real estate broker or a builder. He builds a lot of flats, and he has a lot of inventory of those flats with him. In that case, and if he has a property, can that be termed as a house property that he has? No, because that is the business he's doing, right? So that's a stock in trade for him. So he buys and sells in houses. A person like you and me who do not do real estate business, or we are not builders, for us a house is a asset, an investment. But for a person who's actually doing a real estate business, for him it is a stock in trade. So a stock in trade means he buys and sells those goods. So in that case, if there is any person who does that, then it will not be allowed as a house property. Okay, so just take about 30 seconds, read this slide, and I will get back to you. What it sold. Okay, now next we come to what is composite rent. Meaning of composite rent: the owner of the property may sometimes receive rent in respect of building as well as other assets, say furniture, plant and machinery. I just request you give me 2 minutes. I'll just have some water and come back. All right, I'm sorry. Let's proceed. All right. So, the meaning of composite rent. Now, the owner of the property. The owner of the property may sometimes receive rent in respect of buildings as well as other assets, say furniture, plant, and machinery, for different services provided in the building. For example, lifts, security, power backup, etc. This amount is known as composite rent. So, whenever along with the house property, the owner of the property also receives rent in respect of building as well as other assets, say furniture, plant, machinery, or lift, security, power backup, as a whole package. In that case, it is known as a composite rent. Now, how do we treat the composite rent? Where composite rent includes rent of building and charges for different activities, saying lift, security, etc. The composite rent has to be split up in the following manner. The sum attributable to the use of property is to be assessed under section 22 as income from house property, and the sum attributable to use of services is to be charged under head profits and gains of business or profession, or under the heads of income from other sources, as the case may be. Now, what this simply means, please pay attention. There might be at times you're staying in an apartment complex, and along with the rent, there is also something called as maintenance charges being charged from you. And if it's being charged together, then the entire thing has to be charged as income from house property under this section. But if you can separate it, in that case, the sum attributable to the use of property is assessed under section 22 as income from house property. Let's say a person is charging rupees 20,000 as rent and 5,000 as maintenance. Then 20,000 will be income from house property and 5,000 will be income from other sources or business or profession, as the case may be. All right, are we clear? Now, what is the manner of splitting up? When composite rent is received from letting out of buildings and other assets like furniture, and the two lettings are not separable, that is, the other party does not accept letting out of building without the other assets, then the rent is taxable either as business income or income from other sources, as the case may be. Now, there might be at times where a semi-furnished or a fully furnished house is also given on rent. Okay, in that case, if it is split up, if you can split up for the use of property, then that amount will come as income from house property, and the other amount for the furniture, for television, for air conditioner, whatever is fixed, that will come as income from other sources. But in case it is not in a position to split up, then the entire thing will come as income from other sources or business income, as the case may be. Please take about 30 seconds and go through the slide, and then we proceed. Now, what about income from house property situated outside India? In case of a resident Indian, resident and ordinary resident, in case of individuals and HUF, income from property situated outside India is taxable, whether such income is brought to India or not. In case of a non-resident or resident but not ordinary resident in India, income from a property situated outside India is taxable only if it is received in India. If you go through my previous session on YouTube on residential status, you will notice that there are three types of residential status. One is resident and ordinary resident, and resident but not ordinary resident, and non-resident. For a resident Indian and ordinary resident, global income is taxable in India. Whatever income he earns in any part of the world is taxable in India. For a non-resident and a resident but not ordinary resident, if an income is earned and received outside India for a source outside India, then it is not taxable. So let's put that same situation here in case of income from house property situated outside India. Now, in case a person is a resident Indian and an ordinary resident Indian, and he has a house property in, say, Australia, then in that case, that rent what he receives from that house property from Australia is taxable in India. Okay, whether such income is brought to India or not, for the simple reason that he's a resident and ordinary resident, that income is taxable in India. Now let's look at the second case. In case of a non-resident or resident but not ordinary resident in India, income from a property situated outside India is taxable only if it is received in India. So in the second case, if it is a non-resident or a person who's a resident but not an ordinary resident, any rental income received from a property outside India, say in Australia, will be taxable in India only if it is received in India. If that rent amount is received in Australia or US or Canada or UK, then that amount is not taxable in India for a non-resident or for a person who's a resident but not an ordinary resident. Are we clear? Yes? Take about 30 seconds and go through the slide and then we proceed. Okay, now like I told you in the other slide, that the taxation of income from house property starts with determination of the annual value. And I told you there were two constituents of the annual value. One is your gross annual value and one more is your net annual value. Now we will discuss quickly about how do we calculate the gross annual value and the net annual value. So like you can see on your screen, determination of gross annual value is GAV, which we will talk about. From that, you need to deduct the municipal taxes paid by the owner of the house property during the previous year. And then you get a resulting number called as net annual value or NAV. We will discuss each item in detail as we go on. So please remember, GAV minus municipal taxes paid by the owner during the previous year is equal to NAV. The first step, determination of the GAV of different types of house properties. Where house property or the property is let out during the previous year, throughout the previous year, where the property is let out for the whole year, then the GAV would be the higher of expected rent and actual rent received or receivable during the year. So in first case, the property is let out throughout the previous year. So let's say from 1st April 2019 to 31st March 2020, you let out a property, okay, for the full 12 months. In that case, the gross annual value will be the higher of expected rent and actual rent received or receivable, whichever is high. Then from the GAV computed above, the municipal taxes paid by the owner during the previous year are to be deducted to arrive at the NAV. So once we've got the gross annual value, from the gross annual value, we will deduct the municipal taxes paid by the owner to arrive at the NAV. Are you clear? Please take about 30 seconds to 1 minute to go through the slide and then we continue. Okay, let's proceed. Now, let's take an example. I would request you to pay attention to this. Jay owns 5 houses in Chennai, all of which are let out, and compute the gross annual value of each house from the information given below. So particulars, house 1, house 2, house 3, house 4, house 5. Now, first one, the municipal value of the house. House 1 is 80,000, house 2 is 55,000, house 3 is 65,000, house 4 is 24,000, and house 5 is 80,000. The fair rent. Okay, now let me explain the terms to you. What do you mean by municipal value? Municipal value means certain times when for property tax purposes, the local authorities or the municipality fixes a particular minimum amount for that property, rental amount for the property. So that is known as municipal value. The fair rent. Fair rent is the rent that is expected to be received from a similar property in the locality or whereabouts of the property. Let's say a property is in XYZ location of Mumbai. So in in that XYZ location of Mumbai, what does a similar property get? Rental, that will be fair rent. Standard rent, in a lot of states there is something called as a Rent Control Act, and as per the Rent Control Act, if there is any standard rent fixed by the act, then in that case the standard rent will be that. In case the state does not have a minimum or a Rent Control Act, then it will be 0. And the actual rent received or receivable is, if the property is let out during the previous year, the actual rent that your owner has paid you or is payable to you, but he has delayed it by 1 or 2 months due to some reasons, will be your actual rent received or receivable. So let's read the question again. Municipal value of the house 1 is 80,000, 55,000, 65,000, 24,000 and 80,000. Fair rent of house 1 is 90,000, house 2 is 60,000, house 3 is 65,000, house 4 is 25,000, and house 5 is 75,000. Standard rent, house 1 is 0, house 2 is 75,000, house 3 is 58,000, house 4 is 0, and house 5 is 78,000. The actual rent received or receivable for house 1 is 72,000, house 2 is 72,000, house 3 is 60,000, house 4 is 30,000, house 5 is 72,000. So this is the question. Now from this question we are supposed to find out the gross annual value. As per section 23(1), gross annual value is the higher of expected rent and actual rent received. Expected rent is higher of municipal value and fair rent, but restricted to standard rent. So please remember this. If you want, you can make a note of it. First, we need to compare the municipal value and the fair rent of a property. Whichever is the higher, we need to select that. Okay? I repeat, first we need to see the municipal value and the fair rent of a property. From that, we need to select the higher one. Done. Now we've selected the higher one. That higher amount, we need to compare it with the standard rent. That is, if the Rent Control Act has fixed any standard rent for a property. If any standard rent has been fixed for that property, that higher amount and the standard rent has to be compared, and the lower of that has to be selected. So if your standard rent is 0, you will select 0. You cannot have a negative one. Now, between the higher amount of municipal value and fair rent and the lower amount of that higher amount and the standard rent, we have selected, correct? Now, from that amount, we will actually compare with the actual rent received or receivable, and whichever is higher, we will take that. So let's work out this problem and see. First one, the municipal value between house 1, the municipal value is 80,000 and fair rent is 90,000. So among that, whichever is higher, we select that. So 90,000 we select. You can see it on your screens. Now between that 90,000 and the standard rent of house 1, that is 0, we select whichever is lower. Okay, so we select, so the expected rent is lower of 3 and 4. So the expected rent is, I think there's a mistake here, the expected rent is 0. Alright, so because the lower of 90,000 and 0 will be 0, then the actual rent received is 72,000, and then we need to compare it with the expected rent of 0. So what do we get? We get the higher of those amount as 72,000. Are you clear? Let me just make the correction. Okay, now again the correction for the house 1 is made. Now let's look at house 2 again. House 2, the municipal value and the fair rent between 55,000 and 60,000, which is higher? 60,000. So we select 60,000. Now between 60,000 and the standard rent of 75,000, which is lower? We select 60,000. Now between 60,000 expected rent and expected rent of 72,000, which is higher? We select 72,000. So the GAV is 72,000. Similarly, let's go to house 3. The municipal value and fair rent is 65,000, so the higher will be 65,000. Now between 65,000 and a standard rent of 58,000, which is higher, which is lower? Your 58,000. So we select 58,000. Now between 58,000 and 60,000, which is higher? 60,000. So we select 60,000 as the gross annual value. Similarly, let's go to house 4. Now house 4 is between municipal value of 24,000 and 25,000, which is higher, 25,000. Now between 25,000 and 0, which is lower, 0. So actually we should take it as 0 instead of 25,000 there. And between 0 and 30,000, which is higher, 30,000. So we take 30,000 as the gross annual value. Alright, clear so far? Now let's take the next one. For house 5, the municipal value is 80,000 and the fair rent is 75,000. So which is higher? 80,000 rupees. Between 80,000 and 78,000, which is lower? 78,000. So we take 78,000. Between 78,000 and 72,000 actual rent receivable, which is higher, 78,000. So we take 78,000 as the gross annual value. Are you clear? Please take about a minute and go through the slide and see if it makes sense. Please ask me any doubts you have. Let me just make the correction. Okay, please take about a minute, go through this slide and ask me if you have any questions, because this one is an exercise on computation of gross annual value. Like I said earlier, gross annual value, you need to compare firstly the municipal value and the fair rent, get the higher of the amount. You compare that higher amount with the standard rent and you select the lower amount. Then that lower amount, you compare it with the actual rent received or receivable and select the higher amount. That is how you get your gross annual value. Okay. Now, let's look at the second case. Where first case we saw was where the property is let out throughout the previous year. Now, where let out property is vacant for part of the year, in that case, how do we find out the GAV, gross annual value? Where let out property is vacant for part of the year and owing to that vacancy, the actual rent is lower than the expected rent, then the actual rent received or receivable will be the gross annual value of the property. Now, what do you mean by this? Let's take an example. Let's say a property is let out for 10,000 rupees per month. Okay. So what if in case the property is let out for the entire 12 months period, then what is the rent received? Then the actual rent received will be the actual rent received will be 1,20,000. But let's say that property is let out for a period of 9 months only. So what was the amount that that was received as rental income? 90,000. Now that 90,000, if you look at this table, that 90,000 is the actual rent received or receivable, right? If that is 90,000 and if you compare it with your expected rent, and just because because of this vacancy of 3 months, if the expected rent is higher than the actual rent received or receivable because of those 3 months vacancy, let's say your expected rent is rupees 1 lakh. Okay, and then you compare that with 90,000 rupees as an amount received or receivable. In that case, even though 1 lakh rupees is the expected rent and 90,000 is the amount received or receivable, and due to the vacancy alone, that the expected rent was less than the amount received was less than the expected rent, then you will take the amount received or receivable as the gross annual value. So even though 90,000 is less than rupees 1 lakh, 90,000 will be taken as the gross annual value. I'm talking about the case of house 1. All right. Then the next one. Now we talk about in case of self-occupied property or unoccupied property. Now, in case of self-occupied or unoccupied, now self-occupied property is a property in which the owner of the property himself is staying and he's not letting it out, or unoccupied property is a property which is lying vacant. No one is living in that property. In that case, how do we calculate the gross annual value? Let's take Where the property is self-occupied for owned residence or unoccupied throughout the previous year, its annual value will be nil, provided no other benefit is derived from the owner from such property. Let's say you buy a property and you are peacefully living in that property. In that case, because it is not let out or it's not even being expected to let out, the gross annual value of the property will be 0. Okay? The benefit of nil annual value is available only for up to 2 self-occupied or unoccupied house properties, for either one house property or 2 house properties. Now, the Income Tax Act was amended recently. First, it was just 1 property, then they increased the limit to 2 properties. So, any 2 properties which a person owns and can be treated as self-occupied property, and the gross annual value of both those properties can be taken as 0. Earlier, this limit was 1 property. Third point, the benefit of nil annual value in respect of up to 2 self-occupied properties is available only to an individual or HUF. Please remember, the self-occupied property concept or the benefit of gross annual value being 0 is available only to an individual or HUF. It is not available to your other forms of persons like your company, HUF, association of persons, and etc. No deduction from municipal taxes is allowed in respect of such property or properties. Now, if there is any property which is unoccupied or it is self-occupied and you've taken your gross annual value as 0, in that case, you cannot go on further and deduct any municipal taxes. Because from 0, if you deduct something, it becomes a negative number, and you cannot have a negative number as your net annual value. So only if a property is let out or if you're receiving rental income from that, can you deduct your municipal taxes from. Okay, I request you to take a minute, go through the slide and ask me if you have any questions. Please ask me if you have any questions. Okay, fourth case, where the house property is let out for part of the year and self-occupied for part of the year. So now see, what we are discussing right now is the computation of gross annual value in various situations. Okay, now the first one we saw was let out throughout the year. Then we saw a property which is in which the expected rent is vacant for a part of the year. Then third we saw is self-occupied property or unoccupied property. Then fourth one we see is when a house property is let out for part of the year and self-occupied for another. So let's say you have one house and for 4 months you have stayed in that house and the remaining 8 months you have let out. In that case, how do you calculate the GAV is what we are going to discuss now. Point number A, if a single unit of property is self-occupied for part of the year and let out for the remaining part of the year, then the expected rent for the whole year shall be taken into account for determining the gross annual value. The expected rent for the whole year shall be compared with the actual rent for the let out period, and whichever is higher shall be adopted as the gross annual value. However, municipal taxes for the whole year is allowed as deduction provided it is paid by the owner during the previous year. Now, please remember, whenever a house property is self-occupied for 4 months and let out for the remaining part of 8 months, then you will also break it up, right? When it is a self-occupied property, the GAV will be 0. But for the 8 months during which the property was let out, there you will do this entire exercise of comparing the municipal rent with fair rent with standard rent with actual rent received or receivable, only for the let out period, that is 8 months. Let's say the property was self-occupied for 4 months and 8 months it was let out for 10,000 rupees a month. In that case, the actual rent received or receivable will be 80,000 rupees, and you will do the entire exercise for a period of 8 months for computation of fair value and municipal value. You will compare that, then you will compare that number with the standard rent, then you will compare that number with the actual rent received or receivable. All right, and whatever are the municipal taxes, if it will be allowed as deduction provided it is paid by the owner during the previous year. We will look at a following a couple of slides. We will see how a municipal taxes is treated, but municipal taxes paid is allowed as a deduction in computing the net annual value. Please take a minute and read the slide and then we proceed. Any questions? Please ask. Okay. Now, fifth point. In case of deemed to be let out property where assessee owns more than two properties for self-occupation, then the income from any two properties at the option of the assessee shall be computed under self-occupied category and their value will be nil. Okay, now what happens in the case of deemed let out property? Now, what do you mean by deemed let out property? Can anyone tell me what is deemed let out property? Deemed let out properties, see now, so far we discussed that a person owns a property, correct? So he buys a house, he uses it for himself, so it is a self-occupied property. Problem solved, no confusion. GAV is 0, no municipal taxes, NAV is 0. Alright? Now, let's take the second situation. He buys two houses. One house he is living himself, one house he lets it out for rent. So the house he is living himself is a self-occupied property, so your GAV is 0, no municipal taxes, NAV is 0. Yeah? Now the property that he has let out, let's say he's let it out for 10,000 rupees rent per month. In that case, from that he will deduct the municipal taxes and he will come to a net annual value. So we are clear about that as well. Now let's take an example where a person owns 3 houses. Okay, so as per the Income Tax Act 1961, he can treat any 2 properties as self-occupied properties. So out of the 3, 2 are gone. No problem. Problem solved. Now what about the third property? Now he has a choice that the third property can be let out. He can give it out on rent. No one stops him. So if he gives it out on rent, it will be treated like a let out property. Okay. So we'll find out the fair value. We'll compare with the municipal value. Then we'll compare the standard rent. Then we will compare it with the actual rent received or receivable and find out the GAV. Clear. Now what happens if the third house is also kept vacant? He's living in two houses. He's treated as self-occupied, and the third house he has kept it vacant. He has not let it out. Will the government be okay? Now that is the meaning of deemed to be let out. The government or the tax authorities definitely will not be okay. They will say, see, 2 properties we've allowed you as self-occupied, so you be happy with them. But the third property, either you let it out, you get a rent, and on that rent you pay us the taxes, or we will deem it to be let out. We will deem it to be let out in the sense, even though it is empty, we will treat it as a let out property. Now your question might be, if it is vacant, how will you find out the rent? Then what will be done is, they will take an estimate of what is the rental rate going on in the surrounding locality for that kind of property. So if that kind of property, let's say, has a rental value of 15,000 rupees a month, that 15,000 rupees a month will be applied to that third property and income tax will be charged accordingly. Okay, so that is what you mean by deemed let out property. So let's read. Where the assessee owns more than 2 properties for self-occupation, then the income from any 2 properties at the option of the assessee will be computed under the head self-occupied property, and then their annual value will be nil. Gross value nil, no, municipal tax is 0, net annual value nil. Clear. The other self-occupied properties, that is the third property, shall be deemed as deemed let out properties. This option can be changed year after year in a manner beneficial to the assessee. So let's say the assessee holds 3 houses, house A, B and C. So what this third line says is the assessee is open, or he's free to decide every year which 2 houses he treats as self-occupied and which house he treats as deemed let out. So the first year he might use A and B as self-occupied. The second year he may use B and C as self-occupied and A as deemed let out. And in the third year he may use A and C as self-occupied and B as deemed let out. So obviously he will use the option which makes his tax liabilities minimum. Okay, so the assessee has been given the choice, and the next choice is, please give it on rent, earn the income and pay the taxes. But if you do not give your third property on rent, then it will be deemed to be a let out property and taxed accordingly. In case of deemed let out property, the expected rent will be taken as GAV. Expected rent is, obviously it's a deemed let out property, so there is no rent received or receivable. So whatever is the expected rent you compute, that is the lower of the, first you will compute the fair rent and municipal value. You'll select the higher one. Then from that higher one, you will compare it with the standard rent, and whichever is lower, that will be the expected rent, and that will be the gross annual value. The question of considering actual rent received receivable does not arise. Consequently, no adjustment is necessary on account of property maintaining vacant or realized. Now, if a property is let out on rent, only then will you have rent received or rent receivable. Only then will you have a problem of the property being vacant or unrealized rent. But when you're treating the property as deemed let out, these aspects will not hold good. Municipal taxes actually paid by the owner during the previous year in respect of deemed let out properties can be claimed as deduction. A deemed let out property is nothing else but treated as a property that is let out on rent. So if a property is let out on rent, the municipal taxes what you pay can be claimed. Similar situation will be for a deemed let out property where the municipal taxes paid can be claimed in respect of that property. Please take a minute, go through the slides and ask me if you have any questions. Okay, now we look at, in case of a house property, a portion of which is let out and a portion is self-occupied. So let's say you have a house property with 4 rooms and just 4 rooms. So 2 rooms are let out and 2 rooms are self-occupied. In that case, how will you find out the GAV and how will you treat it is the next point of discussion. Income from any portion or part property which is let out shall be computed separately under the let out property category, and the other portion which is self-occupied shall be computed under the self-occupied property. It's simple as that. If you have a house with 4 bedrooms, 2 bedrooms are let out and 2 bedrooms are self-occupied, the 2 bedrooms that are let out, you will treat it separately like a let out property. You will find out the fair rent, municipal value, find out the higher of that, compare it with the standard rent, take the lower of that, compare that with the expected, with the actual rent received or receivable, and find out the higher of that to arrive at the gross annual value. From the gross annual value, you can deduct the municipal taxes to arrive at the net annual value. This is for those 2 bedrooms which are let out. Now, what happens to the 2 bedrooms that are self-occupied? Obviously, those are self-occupied, so you cannot have a gross annual value. The gross annual value will be 0. The municipal taxes will be 0, net annual value will be 0. But please remember that's one property, right? So let's say if you are paying municipal taxes for the whole house as 10,000, you will divide that 10,000 into 2. 5,000 for the let out portion, 5,000 for the self-occupied, and you can claim only 5,000. The remaining 5,000 for the self-occupied cannot be claimed. Okay. Now, there is no need to treat the whole property as a single unit for computation of income from house property. Like I told you, 2 bedrooms will be treated as self-occupied, 2 bedrooms will be treated as let out. Municipal valuation, fair rent, standard rent, if not given separately, shall be apportioned between the let out property and self-occupied property portion, either on plinth area or built up floor area or on such reasonable basis. Now, please remember the standard rent, the expected rent, the fair value, municipal value is not given for 2 bedrooms out of 4 bedrooms. They will give it to you for the whole house. But if you have let out half the house and if you are staying in half the house, whatever is that standard rent, fair rent and your municipal value, you will have to find out that for the whole house, divided by 2, by 50, because 2 bedrooms are let out, 2 bedrooms are self-occupied, and you will have to do the computation. Property taxes, if given on a consolidation basis, can be bifurcated as attributable to each portion on a reasonable basis. Like I told you, even the municipal value or the municipal tax for the house will be as a whole. It's not per bedroom. So whatever is the house, municipal tax for the whole house, you will have to break it up using some reasonable basis. Please take about 30 seconds, read the slide, and then we proceed. Okay, so I think we will be, so if you've read this whole thing, and then we can proceed. So we have discussed, what are the topics we've discussed today? We have discussed about gross annual value, net annual value, and what are the different cases in which the gross annual value is determined. The first one is if entire property is let out. The second one is when let out property is vacant for a year. Third point is in case of self-occupied property or unoccupied property. The fourth one is where house property is let out for part of the year and self-occupied for part of the year. Fifth one is in case of deemed let out property. Sixth one is in case of a house property, a portion let out and a portion self-occupied. So we have treated this. We will continue with income from house property in the next session, as I would like to end today's session here, because the next topics are again quite important and we require adequate time for that. So I thank each one of you for being a wonderful audience. Thank you so much. And please, for the people who have not followed my profile on the Unacademy app yet, I request you to go to the Unacademy app, go to my profile and click on the follow button to get live updates about the sessions and timing of my sessions. And for the people who have not downloaded the Unacademy Learning app yet, I request you to download the Unacademy Learning app on your mobile phones as soon as possible and register on it. Registration on it is quite easy. You need to enter your mobile number and you get an OTP. You enter the OTP and using that OTP you can register yourself and carry the whole world of courses, resources and contents that Unacademy has to offer to you. And lastly and most importantly, I also would like to remind you about the Plus subscription of Unacademy, which is a payment-based model, which gives you a lot of benefits like live classes with your educator and the topics, which helps you clear your doubts on a day-to-day basis, on a daily basis, and you can discuss with your educator, talk to them and clear your doubts and chat with them. The next one is it conducts regular courses and tests and quizzes to evaluate your performance, to find out how your preparation is, which is your strong area, which is your negative area, and to focus on that and to convert your weak areas into your strong areas. The courses provided by the Plus platform of Unacademy are structured in the senses they guide you in a step-by-step manner, and they ensure, or they try to the maximum level possible, that your complete preparation for the examination is done and there is no important topic left by the time you prepare your thing and for the exams. And most importantly, it gives you unlimited access. It gives you access to the live recordings, live sessions, recordings, and you can carry this on your mobile. You can use it whenever you want and access it whenever you find the time. You do not need to schedule a time for it, because it is in your pocket in the mobile phone, and you can access it at any convenient time using your mobile or anything at whatever time of the day you want. So I request you to be part of the Unacademy Plus program as soon as possible. The packages provided are for 1 month, 3 months, 6 months, 12 months and 24 months. The cost of those packages are given earlier in the slide. You can have a look at them. And while making a subscription, please do not forget to use the code Prathik, P-R-A-T-H-I-K, to get a discount of 10% on your subscription price. I hope you make use of this opportunity and come on board the Unacademy Plus program as soon as possible. And in case you also have any doubts, and I personally suggest the 12 months and the 24 months package to you, simple for 2 reasons: cost effective, and next is for any major examination you need to get enough time to prepare for them. So a 12 months and 24 months stands good for you. And do not forget to use the code Prathik, P-R-A-T-H-I-K, to get a discount of 10% on the subscription price. So please go ahead, make the most of it, and I hope you grab this opportunity. I also have other sessions in the archives on Companies Act, Part 1 to 6. I have the Indian Partnership Act, Indian Contracts Act, the Limited Liability Partnership Act, the Sale of Goods Act, Basics of Income Tax. So I request you to go to the archive and refer those lessons as well. It was a pleasure to address all of you, and I will see you around soon. Thank you so much. Take care.